Does, because the banks, as well as getting their funding from international wholesale markets, are actually getting their funding from mums and dads saving here in New Zealand in term deposits. And as the official cash rate has been cut, those term deposit rates at banks have also been cut quite heavily. And there's been this shock factor when mums and dads have realised when it came time to roll over their term deposit, then suddenly the bank was offering a 3-point-something% instead of a 7-point-something%. And they've rebelled. They've said, no, I'm not going to do that. I'm going to put my money into a guaranteed finance company, or I'm going to put it into one of these corporate bonds that's around right now. And so the banks are realising they simply can't cut their term deposit rates in line with the official cash rate.
So again, do we believe them when they say that part of this move on the longer term is actually pressure from savers? Savers are shopping around between banks or even outside of the bank sector.
Yes, both mums and dads here in New Zealand and the big institutions internationally, they will not accept a savings rate of less than 4 or 5%. They just say no.
What does that mean then for savers, for people who do have deposits available at the moment? What message do they take from what has happened to the rates on the longer term and where they may head?
Well, they should demand from their bank a relatively high rate. So we're talking 4, 5, 6%. I mean, you can get 6% if you're investing for the long term, 5 years or so at a bank. And you should say to your bank, you know, hey, there's this corporate bond coming up that looks pretty good. You better compete for my money.
How much influence then, I think you've probably answered already, does the Reserve Bank have on interest rates? Quite a bit on the short term, very little on the longer term.
That's right. And so if you've got a variable rate or maybe even a 6-month rate, you have to watch very closely what the Reserve Bank is doing and what Alan Bollard is saying. But if you've got a 2, 3, 4, 5-year mortgage, you should really be listening in every morning to hear what Barack Obama and Timothy Geithner and Ben Bernanke have been saying overnight, because those international events. So when Barack Obama pops up and says, hey, we're going to borrow $1.7 trillion this year, or Ben Bernanke says, I'm going to print $300 billion. That is what you should be listening to, because that was what will affect your next rollover price.
Explain that, because it's just happened. We've had a bailout, as you said, another $1 trillion or more going in to try to unclog the credit market in the States. This time it's the government and the banks in some kind of joint operation to try and contain the so-called toxic debt. What is the likely impact of that on us?
Well, it's just another chunk of money that the US government is going to pump into the system. Whether it's funded, when I say funded, as in they've gone out into the markets and borrowed the money, we'll see. So far, we've got the Federal Reserve Chairman, Ben Bernanke, who's now called Helicopter Ben, because he had this phrase a few years ago where he said, if you ever really wanted to get an economy going, what you need to do is fly a helicopter over the economy and tip money out the door. And that's what he's doing. And every time you do that and you print the money that you're tipping out the door, you're devaluing the currency and you're pushing up interest rates and inflation long term. So when you hear the US government say, we're going to print more money, we're going to spend more money, we're going to borrow more money, that should tell investors and borrowers that interest rates long term and inflation long term are going to rise.
What of the inflation track? You mentioned some people having expectations about that. It has come down over time domestically as some of the pressures like the housing market ease and oil prices have come down. What are the pressures on it into the foreseeable future?
Well, we've already seen the oil price jump up over $50 a barrel. And when you have this sort of money printing going on, eventually, as you pour petrol into the engine, it catches fire. And that's what we're going to see in the global economy. And we've already had Reserve Bank Governor Alan Bollard say at a parliamentary hearing a couple of weeks ago that he fears a very nasty inflation shock in a year or two's time, as this printed money, and of course these days you don't actually print it, you just Control-C, Control-V with a new spreadsheet tab, that is being pumped into the economy right now. And eventually it will catch fire. You know, people will go, suddenly I've got all this money lying around buying the same goods and the prices will rise. And that is a concern for everyone. You hope that the US Federal Reserve and the Bank of England and the Bank of Japan decide to turn off that petrol hose, just at the right moment before the engine gets too hot. Otherwise, we will have an explosion.
So anyway, for folks sitting here this morning, it's a case of what? The long-term rates are probably as good as they're going to get, the 3, 4, 5 year interest rates, if you are borrowing for house or for business. The short-term rates may stay down for a while, but up to you when you think it's hit the bottom. And you've got to really decide, what you need to lock in when.
Yeah, you've got to take a view on where you think inflation and long-term interest rates are going. If you think they're going to rise, and I think they are, then you look to lock in longer term. If you for whatever reason, you might have a personal reason to say, well, I need to stay short, I need to have a variable rate because I'm paying off my debt, I'm expecting a big redundancy payout, or I'm expecting inheritance or whatever, then that makes sense to stay short. It depends on your personal situation, but if you're in for the long haul, you've got a 20-year mortgage and it's all about keeping your outgoings low for a long period, then look to fix 3, 4, 5 years.
And if you've got deposits available, if you're a saver, you should be tub thumping and perhaps anticipating you might get some rate increases at the upper end.
That's right, and it does make sense to wait for some of these longer term rates to rise, and it may only take a few months before we're seeing that flow through, and we are seeing it flow through. You can get 6% from a bank now if you're investing for the longer term.
Thank you for your time, Bernard Hickey of the Interest Rates Monitor, Daily Monitor of Interest Rates. It is interest.co.nz, the website address.